If headlines about Iran and war are making you nervous about your investments, you're not alone. Geopolitical conflict can move oil prices, stock markets, interest rates, and currencies, sometimes violently. But here's the most important thing: panic is expensive, discipline builds wealth. Today we're going to calmly break down what actually happens to markets during Middle East conflicts, how oil, inflation, and interest rates react, which sectors get hit hardest, and the rational options investors have. This is educational only, not financial advice. The goal is clarity, not fear. And always get your own independent professional financial advice. Now take a breath. Let's think strategically. Iran sits near the Strait of Hormuz, one of the most important oil shipping routes in the world. If conflict disrupts oil supply, oil prices spike, energy stocks often rise, inflation expectations increase, bond yields may rise, rate-sensitive stocks can fall. Markets hate uncertainty. But here's something important. Historically, most geopolitical shocks cause short-term volatility, not permanent market damage. Look at past events: Gulf War, Iraq War, Russia-Ukraine conflict. Markets typically drop fast, then recover once uncertainty stabilizes. The first move is emotional, the second move is rational. If oil spikes sharply, growth stocks often struggle due to higher inflation and rates. Banks can be pressured if recession risk increases, and consumer discretionary may weaken as fuel costs squeeze households. Energy companies often benefit, so the question becomes, do you react or stay disciplined? This is the most underrated strategy. If you are a long-term investor, doing nothing is often the correct move. Markets recover over time. Geopolitical events come and go. Human innovation continues. If your portfolio is diversified and you're investing for 10 to 20 years, you may not need to change anything. Sometimes the highest return action is no action. If volatility increases and you feel uneasy, you can temporarily pause investing, build cash, let markets settle. If prices fall significantly, you can average in at lower levels. This reduces emotional mistakes while keeping you strategic. This is not market timing, it's capital allocation discipline. If markets fall 10%, 15%, 20%, that is mathematically future return being pulled forward. Long-term investors historically benefit from buying during fear. The key: don't go all in at once. Deploy in stages. Stay diversified. Volatility creates opportunity, but only for disciplined investors. For more experienced investors, there are hedging tools. Again, educational only. Examples include inverse ETFs that move opposite to the market or target rate-sensitive sectors, and oil ETFs for supply shocks. But understand, inverse ETFs are short-term tactical tools. They can decay over time. They require monitoring. These are not buy-and-forget investments. Hedging reduces downside, but it also limits upside if markets rebound quickly, so use caution. Markets price in worst-case scenarios quickly, but full-scale, prolonged regional wars are rare. Oil spikes are often sharp but temporary, and central banks respond if inflation surges too far. Ask yourself, is this a temporary shock or a permanent change to global productivity? History suggests most are temporary market events. Remain calm. Wealth is built over decades, not headlines. If you panic sell, you lock in losses. If you stay rational, you keep optionality. Volatility is the price of admission to long-term returns. This video is for educational purposes only and is not financial advice. Markets are volatile. Inverse ETFs and commodity ETFs carry risk. Always consider your personal situation and speak with a licensed advisor. Capital is at risk. If this helped you think more clearly about market volatility, subscribe to Infinite Wealth Education. On this channel, we focus on long-term investing frameworks, risk management, and building wealth calmly. Avoiding emotional decisions. Drop a comment below. Are you staying invested, building cash, or hedging? Let's discuss strategically, not emotionally. Stay calm, stay disciplined, build long-term wealth.